Welcome back to episode 27 of the Real Estate Syndicator Live. And today I am, look at the amount of questions that I already have ready for my friend Yonah Weiss here. But of course, this whole thing is for you guys. So make sure you ask your questions in the chat. Otherwise, I'm going to be asking all the questions myself. So Yonah, thanks for coming on, my friend. Yonah, for those of you who have been living under a rock, is a cost segregation expert with Madison Specs, which is a licensed, and that's an important term, licensed national cost segregation leader. Over the past 16 years, Madison has done about 20,000 cost segregation studies covering all 50 states and resulting in over $3 billion in tax savings. And I think, my friend, you mentioned that you yourself have been responsible for hundreds of millions of dollars of tax savings. So really appreciate you. Obviously, a lot of interest here about the topic. So let's start with the basics, Yonah. I was going to start with the farming and the goats and everything, but for those of you who weren't on before, had some technical issues, so I don't want to waste any more time. But that was kind of a funny thing with the being the goat or farming boats. But no investor left behind, no syndicator left behind. Why don't we start by talking about what depreciation is, specifically bonus depreciation, and then how cost segregation fits into that puzzle.
Absolutely. Appreciate you having me, Mauricio. It's great to be here. Great to be among so many esteemed colleagues as well. Awesome to have so many people I already know here. And so I feel like I may be preaching to the choir a bit because a lot of you already know the power of cost segregation, but we're going to break it down because it's always good to just continue your education, reiterate those things that you already know and review them from time to time as well. And sharpen the saw from the 7 habits is probably one of the most important, if not the most important of the habits, to just continue education, keep getting better. So long story short, depreciation is a tax deduction. Okay, it's a name of a tax deduction. It's based on the concept that things go down in value as time goes on, but that's not what it means. And so it's really important just to get that clear, because some people erroneously make the definition and think, oh, depreciation is a bad thing. I don't want my property to go down in value. Really, we're talking about a tax deduction that's based on that concept. Okay, so the IRS has given this name to anytime you buy a property, whether it's a business or investment property, besides for your personal residence, any type of property, you're able to take a tax write-off from your income tax of the entire value of that property. Okay, it's based on the purchase price, not the market value. And we're going to subtract a little bit for land. Land does not depreciate, and I want to be clear on that. We're going to get to that in a minute. There are things on top of the land that do. So how depreciation works is, generally speaking, we're going to take that purchase price, divide it up by 27.5 years for residential properties or 39 years for commercial properties, and you get a little bit each year. Okay, that's how depreciation works. It's usually enough to help reduce your tax liability from your property. But the strategy of cost segregation and bonus depreciation is really pulling from that pool of potential deductions. And instead of taking a little bit each year for 27 years, you may not hold the property for 27 or 39 years. You're going to pull from that pool of deductions and essentially take and front load a good percentage of them, so you can take those tax deductions up front. Because as every accountant knows, right, Finance 101 is the time value of money, is knowing the value that I can have if I use that money today to invest instead of not being able to have access to those funds. So essentially it's taking from, like a fund that's yours of these deductions, and instead of taking them a little bit each year, again, just keeping it simple, taking a big lump sum in the first year or over the first few years. So to get into the details of how that works, happy to do that, but that's just a nutshell explanation.
So if I'm hearing you right, let's say I'm buying a $1.2 million property, just to keep the math simple. Some percentage of that's going to be land, some of that percentage is going to be the property and the improvements, and that's, my understanding, is a conversation with your CPA to figure out what that split is. But let's just say there's $1 million that's attributed to the property itself, not the land. Yep. The idea is that over time, over either 27.5 or over 35 years, that piece of property is actually having wear and tear and just kind of depreciating in value, and you get that tax pickup, which makes sense, except we all know that most likely in the next 37 years, the property is going to be probably worth more, even though from a tax perspective, it's going to get depreciated down to zero. But where does the cost segregation fit in? Why can't I just say, hey, look, I bought this property for 1.2 million. Great. my CPA decided that $1 million was what was the improvements, I'm just going to write off $1 million. Like, why do I have to go through a firm like yours and do a cost segregation study?
Well, so you're absolutely right. I mean, the depreciation, you're going to take that $1 million, but you have to spread that out evenly over a 27.5-year period. Okay. But the IRS has said that there are certain components of a property that actually depreciate faster. Certain things like personal property, things that are non-structural, will depreciate over a 5-year period. And so other things outside the property, like land improvements, will depreciate over a 15-year period. And so by identifying what those things are through a cost segregation, an engineer-based study of the property, we're able to pull out those assets and take the tax deduction of those assets at a faster rate, meaning a CPA can't do that unless they have that engineering background and do that very detailed study. But I do want to just go back to, before I get a little more into that, back to one thing that you said about, the property maybe going down in value and it's going to be fully depreciated. It's not really so. It's a borrowed, depreciation is a borrowed term because it's not intrinsic to the property itself. Depreciation begins the day that you buy a property, and it can change hands 100 times, and each new owner will start their new schedule of 27 years the day that they buy it, based on their new purchase price. So again, it's not intrinsic to the actual depreciation of the property. It's a borrowed term based on that principle. And I just want to reiterate that, because you may have bought that property for 1.2 million, and in 2 years from now, you're selling it for 5 million. And that new owner is going to be able to take that $5 million deduction. Again, he's going to start that 27-year schedule. But again, you're going to be taking it based on that subjective amount.
Yeah, I mean, that was just kind of talking about the concept of depreciation. Just like when you buy a piece of machinery, obviously, you buy something new and then there's a lifetime value of that machine, right? And over 10, 15, however long it's going to last, over time, that piece of property is going to kind of wear and tear. And at least theoretically, that's what it happens with real estate. But as you mentioned, which is an excellent point that I missed, which is whenever the property changes hands, that number actually resets, right? So if it's 37 years and I could hold it for 5, the minute I sell it, it gets to reset over 37. So probably one of the reasons is not, a lot of people, when it gets to 37 years, they may think about selling it even if they didn't want to, just for the depreciation piece. You mentioned something about engineers and something. Is this something that I can do on my own? Is this something, there's a lot of do-it-yourself firms out there? And is that something that they can do on their own? Or do they have to go through a cost segregation company like yours? So
typically speaking, I mean, the IRS has actually rules. It's called the Cost Segregation Audit Techniques Guide. And that's how, all the rules are in there, all the regulations and how they're looked at from the IRS's eyes in an audit sense. The highest form of the cost segregation, which is totally audit proof, essentially, is called the quality cost segregation study. That is required to be done by someone with engineering and construction experience. And so that's why you need a third-party firm to do that. However, there are some companies out there that have created some sort of do-it-yourself software algorithms approach. They are not fully audit protected, and they don't fit up to that highest approach. But some accountants on very small properties, I've heard, recommend doing that, just because it's very cheap and expensive, and there may not be a worry of being audited per se, and so therefore just to at least have those numbers broken down. But for the most part, for all the years that it's been in the books, it's been entrusted in these third-party companies to have the engineering report, and even the large accounting firms like Grant Thornton and KPMG, right, EY, they have engineers in-house, so they're doing cost segregation for all their clients the proper way.
Because you work with the CPAs, right? You're I mean, you're not necessarily a CPA yourself. You're actually, it's not like you're taking over that role from your CPA. You actually work with the CPA as one component of that process, right?
Correct. Yeah. I mean, it's something that's amazing because, CPAs do not do this for the most part. 99% of CPAs will not, or some don't even know what it is. But yeah, we're not an accounting firm. We focus solely on the cost segregation. We have a number, I think 5 or 6 CPAs on staff in-house, but all we focus on is that, just to make sure we're, fully compliant and reviewing all the reports, et cetera.
Yeah, that's good stuff. And then I'm already seeing a bunch of questions in the chat, so I'm going to get to those in a second. And if you've got a question, definitely drop it in there. One of the things we were talking about, I think in our social media interactions, a lot of people, I think, believe that the cost segregation and the bonus depreciation only really applies to the actual building, whatever that structure is. But, our good friend, I want to do a little plug and maybe we can give the details at the end, but our good friend, Brandon Turner, who's been, a guest on the show, client of ours, he's in the mobile home park space, right? And there's somebody asked a question about RVs. And so does the bonus depreciation and cost segregation apply to, say, a mobile home park or an RV, even though those legally aren't really real estate? They're actually technically chattel, or they're sort of a personal property. But does somebody like Brandon, who buys a large mobile home park, does he get some of these tax benefits if you're in that specific asset class?
Absolutely. And it's an excellent question. The assumptions are very good and the questions are good. How depreciation works is looked at in a real estate transaction. And so everything that's included in there, if you don't do a cost segregation, everything is just going to be lumped together on that 27-year schedule, 27.5-year schedule. However, by doing the cost segregation, we're able to break down or separate those entities or those components that do depreciate faster. So in a mobile home park, you may have the homes themselves, and those homes can be either determined as 5-year personal property, right? And again, those things that depreciate over a 5-year schedule, or sometimes the homes, if they're permanently affixed, will be considered structural components. The major thing that actually, and RVs may be similar, although RVs are usually treated just as 5-year property if you buy the RVs. But the interesting thing is, in most mobile home parks or most RV parks, you're not actually buying the homes themselves. And in many cases, they're buying these parks, which are fully what's called tenant-owned homes. You're just buying the land and the concrete pads under the homes and the infrastructure, et cetera. So in that case, you may own a couple of homes, and again, that's going to be included there. But in the case of mobile home parks, there's a really interesting factor that what you're buying is land. Remember, land doesn't depreciate, but what's on top of the land does. And so you may have concrete pads under each home. You as the owner, that's what you're buying essentially. So the value of your purchase is going in the real estate and everything that's included in that. So mobile home parks typically will have anywhere between 50 to 80%. We're talking 50 to 80% of the property being allocated to that 15-year, what's called land improvements, concrete, pavement, landscaping, fencing, all the things that are, in the park. Because there's no structure there, and the homes, if they are 5-year, if you do own them, they are personal property, they'll be included in the cost segregation. But again, it's all part of that purchase.
Yeah,
so it's a really good point.
Roads. A lot of these parks just have miles and miles of roads and stuff. And I was actually I was really surprised when I first heard about that, because I was like, obviously we can't depreciate. We don't even own the mobile homes, let alone depreciate as real estate. But all that other stuff. The lighting, the fences, that's pretty good stuff. Talk a little bit about the recapture. Sorry, I had that question, and one of our Aman Shashi was asking that in the comments here in the chat. So talk about the recapture, because that kind of messes me up actually, just on a personal level and some other stuff that I do. So talk a little bit about the concept of recapture, and then your thoughts on, is that sort of the negative, or how do we mitigate those negatives? But talk about what exactly this concept of recapture is. On a cost segregation, both on a depreciating asset.
Yeah, absolutely. And remind me to get back to the bonus depreciation, because we didn't really touch on that entirely. But recapture tax is probably one of the most misunderstood concepts when it comes to depreciation. You'll find a lot of people, I see this on Bigger Pockets all the time, people saying outright that cost segregation isn't worth it because you're just going to pay it all back when you sell. And that's just blatantly wrong. That's not what recapture means. So let's define what recapture tax is. When you sell a property, you're going to be subject to a capital gains tax if you make a profit on that. And similarly, the depreciation is considered an unrealized gain, meaning you're going to be subject to a tax on the amount of depreciation that was taken during life ownership. So take your example, your $1 million property. If you took, $200,000 up front, right, with bonus depreciation, let's say you took it and you sold the property. Of that $200,000, it does not mean that you don't have to pay back that $200,000. That's wrong. It means you're not going to be subject to a tax on that $200,000. It's broken up into different categories. Certain portion of that will be taxed at a 25% rate, which is similar to capital gains for tax, and some of it will be taxed on your ordinary income rate. Meaning, at most, right, you're going to be paying maybe the highest rate possible. 40, 49%, whatever it is. In California, probably much more, right? But let's say 50%. But again, that's much less than paying back the full amount. That's not what it means. couple things just to kind of reiterate that and to clarify it further. Being subject to a tax is not the same thing as paying tax, okay? And certainly not the same thing as paying back the deductions that you took. So we all know of something called, or maybe we don't all know, I shouldn't assume, but there's something called the 1031 exchange. This is a very common practice, which allows you to exchange one property for another property in the event of a sale. That allows you to defer the capital gains tax and also defers this recapture tax. So that's one clear and simple way to not have to worry about that, at least at the time of the sale, to kind of kick the can down the road and defer that further on. Another important point about the recapture tax is, since it is considered a passive gain on the sale, similar to capital gains, when you have depreciation or you have a cost segregation done from one property and you're creating these passive losses, well, those passive losses, you may have a large portion of them, and those can offset those passive gains. And let's say you bought this property and you took, $200,000 of depreciation and you didn't use it all up, maybe used up $50,000 of it, and you have this extra $150,000 of passive losses that are just sitting there in this imaginary bank account on your tax return. Those passive losses carry forward from year to year and are released on the sale, which means whatever passive losses that you have can be used to offset that passive gain from the sale, including that recapture tax. So there's a benefit of the depreciation in the year that you do the cost segregation by reducing your income tax liability. And there's also the benefit of the cost segregation by having that big pool of passive losses that can help you on the sale as well. So I think it's just outright, like, I don't know, it's wrong, but it's also just misinformed that to say that it's not worth doing cost segregation because you're just going to pay that depreciation right back. It just, to me, it never makes sense that someone doesn't understand the full concepts of this. However, if your plan is you're going to buy one property and that's it for your whole life, and then when you sell it, right, you're maybe going to buy another one, maybe not. Like, yeah, it may not make sense for you to do the cost segregation necessarily, but if you are a real estate investor and continuing to buy and sell, this is just probably the best strategy that exists to continue to scale, in a tax-free environment.
Yeah. So when does it actually make sense then to do a cost segregation study? Because that was another question that popped in actually before in an email that came in. Somebody was saying, "Hey, I bought a duplex. I put it into service in the middle of the year." So talk about timing and whether it makes sense. Is there like a magic number, $1 million, $10 million, where if it's something's too small, it doesn't make sense? And then talk a little bit about, there's a question in the chat as well, is that taken at the time you purchase the thing? Is it done annually? Talk a little bit about those two issues.
Yeah, all great questions coming in, guys. And keep the questions coming, by the way. I know we have a limited time here, but whatever questions we don't get to, I'm happy to answer afterwards also. But I like to use general rules of thumb, although there are individual situations where it will apply or won't apply otherwise. And so I'd like to even start with taking a step back and understanding who can benefit this the most, and not necessarily the property, because it less has to do with the property size per se than it does the individual, because cost segregation creates these passive deductions, but there are limitations to that. Meaning, if you are not a real estate professional, you're going to be limited to how much of those passive deductions you can take beyond your passive income. Okay, so rental income, real estate income is treated differently than your W-2 or other sources of income, in which case the depreciation is going to be used to offset that. So if you're a real estate professional, or your spouse is, or you're doing short-term rentals, something I'll get into it a little bit later, there's a kind of a loophole there. Then doing cost segregation on basically any size property is worthwhile because you can use those deductions, those losses, to offset any type of income. Okay, not just your passive income. But in general, my rule of thumb is pretty much anything purchased for over $500,000 purchase price is pretty much a no-brainer in terms of the 10x benefits of how much it would cost to get it done versus how much you can use of that depreciation. But again, it will ultimately come back to, can you actually use those losses in the current year, and how much of them can you use?
Do you, if somebody's not quite sure, right? Let's say in my example, maybe I have a property that's like a duplex, it's $600,000 or $700,000.
Yeah.
Obviously there's certain tax savings, potential tax savings, and there's a cost obviously to do the cost segregation. How does it work with your firm or any firm in terms of finding out whether it's even worth doing one? Like, do you run some preliminary numbers and say, hey, look, back of napkin, I think it's going to make sense. Or you know what, if with 500 grand, you're going to save $5 and it's going to cost you $7 to do it.
Yeah, absolutely. There's obviously a fee that's involved in it. We always run, and most companies will run, a free feasibility analysis upfront, so you can know ahead of time what the potential tax savings would be. And you could say, hey, I bought this duplex for $600,000, right? What can I save in taxes if I do cost segregation versus if I'm just going to take straight line regular depreciation? And so, yeah, we'll run those numbers. It usually takes a day or two just to get those numbers back. And it's, like I said, it's pretty much a no-brainer over $500,000 purchase price, any type of property. And in terms of, you asked before, when should you be getting this done? It's really has more to do with you. When is this going to be most beneficial? Most people like to get it done in the first year because you want to make sure to get, number one, get your taxes set up properly right the first way. It just kind of saves you. And number two, even if you can't necessarily use all of those losses now, they will carry forward, meaning you don't lose the deductions if you don't use them in the current year. So you'll have them to use in the future. And so it does make sense in many cases to get the cost segregation done in the first year. But even if you never did it, let's say you've owned a property for a number of years and never got it done, you can now go ahead and do it retroactively without having to amend your tax returns. So there is that option as well.
That's actually, I was actually literally going to go to Vinny's question, which is it beneficial to do a cost segregation in year 3 for the improvements done in year 1? So I guess that goes to the timing.
It does. It has to do with the timing. So improvements is really a whole separate subject when it comes to cost segregation, because typically what we're doing is the cost segregation is on the acquisition itself, right? You buy a property for $1 million. We're going to take that $1 million and break the components down and show you what the tax deductions you can get from that. By adding improvements or doing improvements, that's something separate. That's on top of the purchase or the acquisition. And so those are costs that can and should be depreciated and can be broken down as well. It's best to do the cost segregation on improvements, meaning like a renovation study, we call it. It's a separate thing from the acquisition as soon as you get those renovations done, meaning instead of waiting a few years to do it on the renovations, to get the cost segregation done on that, as soon as possible, so we can, see what those costs are.
I know this is in your wheelhouse now, because actually this is probably a question for the CPA, and I know we've got a bunch of CPAs in here. I know, Justin, you're in here, but David said something. I want to make sure he's focusing more California, but I'm going to suggest that we focus on another issue. David asked, my understanding is losses cannot offset active income in California tax purposes. Putting aside California tax law, the savings here go against passive income, correct? Not active?
Correct. Yeah, it will go against passive income. That's where the depreciation hits. And again, unless you or your spouse are what's considered a real estate professional, you're full-time working real estate, that's where the depreciation will stay. It'll just be passive losses. If you are a real estate professional, it will carry over and you can use those to offset your active income, W-2 income, whatever that is. So it doesn't have to do with California taxes. We're talking federal income tax here. What you do bring up about California is there are certain states that don't recognize the 100% bonus depreciation on a state level. So maybe that's a good segue to kind of get back to that question you asked I never answered.
Please.
About the bonus depreciation. And a lot of you probably heard about this before, but if you haven't, if you have heard about the bonus depreciation, just write in the chat, 100% bonus and or something like that, 100%. Just let us know you're still listening. That's all I want to do right now. But 100% bonus depreciation.
I got 60 people listening to you, my friend.
Okay, you never know. People, they chime in and they're kind of like I do when I'm on a Zoom, multitasking and stuff. I kind of have to say, no, I'm just kidding. But we got a lot of engaged people here, and that's really important. So bonus depreciation was a new law that came about a few years ago in the Tax Cuts and Jobs Act. And what it said is that once you've done a cost segregation, and have established what those 5-year, 15-year property assets components are, you can now have the option to take that full amount of accelerated depreciation in the first year. So that will give you a huge tax write-off. Instead of what it used to be is just, we're saying there's 20% of this property, that $1 million property, 200,000 that you can spread over a 5-year period. And so that's great. You're doubling or tripling your deduction over the first 5 years. But now you have the option to take that as a lump sum in the first year. So take that 200,000 as a tax write-off in the first year. That's huge. I mean, that changed the game for so many people. But there are certain states, California included, that on a state level, state income tax, they won't recognize the 100% bonus as that lump sum. So what we do is we always prepare, when we do a cost segregation study, we prepare two different schedules: the regular cost segregation schedule of the 5-year, 15-year, et cetera, broken down, and the 100% bonus schedule. And you can use either one based on what state you're in for federal or state levels.
Yeah, and so thanks for clarifying the bonus depreciation part. And you already mentioned it earlier, Yonah, but I wanted to focus on this for the maybe first timers and sort of a little bit more on the basic side. But the cost segregation is done. You mentioned it on the property cost, the acquisition cost of the property, right? Whatever the property costs. But most of us aren't buying properties all cash, right? And so even though I might only be putting down maybe 30%, maybe it's a 20-25% down payment and some other additional value added, whatever, I'm going to get most of that back in year one now with the bonus depreciation. I mean, it's not 100%, but it gets pretty close, meaning because it's based on the $1 million number, if I'm investing 250 grand, I might get close to a $250,000 or $200,000 deduction in year one, right?
You're exactly right, because the depreciation is based on the purchase price, not at all based on how much money you actually put in, which is another amazing thing. I mean, you're getting the tax benefits from the bank putting in money. So, and especially when you're dealing with properties like multifamily or mobile home parks, where it's, as I mentioned before, the amount of bonus depreciation could be 50 to 80% of that purchase price in the first year. You can be doubling or tripling your investment, your cash investment or your equity on that first year.
Yeah, no, for sure. And then Jason actually asked is whether that tax, whatever the tax benefit ends up being, if you're in a syndication and you're a limited partner in one of those syndications, does that actually apply to you? Does that flow through and can a limited partner get that benefit?
Yeah, it does flow through, and limited partners can generally and should be getting that benefit. There are certain scenarios where you might create an operating agreement to kind of allocate depreciation differently, but that's more maybe in your wheelhouse how to do that. But generally speaking, yes, according to your percentage of ownership, you will be getting that percentage of depreciation allocated to you.
Yeah, and I think Senate was asked the same thing, whether the cash flow throws to the LPs. Maybe at the end, if we have time, we probably may not. I know there's a couple of CPAs in there, but I know specifically Justin, I know some people on his team, of whether the depreciation of the tax benefit flows. It definitely flows to the limited partner. I think the big issue that we have is what percentage or how much of it flows to the general partner and the sponsor, because just because you may own 20% of the property through the LLC doesn't necessarily mean you're going to get 20% of the depreciation or the bonus depreciation. A lot of time that follows the actual cash invested. So just be aware of that. And again, I'm not a CPA, but that's one of the big issues that has popped up, is that I may own 20% of the property through my syndication, but if I only put in $50,000, which represents 3%, then I may only be getting 3% of that tax depreciation. But anyway, got a lot of questions. So I'm going to start going through these, Yonah. And,
sure. Well, you still have like 3 pages of questions also, right?
David says, California, to my understanding, limits all losses. Okay, we just talked about that. So we got that. Oh, great. Everybody's listening. Of course. We're talking to the GOAT here. Can bonus depreciations be carried through to LPs in fund of funds? That's an interesting question. I'm going to say the answer is yes, Yonah, just because it's all from a tax perspective, it's all disregarded and it kind of goes to everybody's tax. It just follows the chain of ownership.
Correct. Yeah. Generally speaking, unless there may be some differences with blind funds or things like that, where you're not actually investing in a property necessarily. You may not be getting that, but typically speaking, yeah, it flows through. These are flow through entities. It's
one of the just a parenthetical comment. That's one of the downsides of promissory notes. A lot of people like to raise capital through promissory notes, but obviously if you're lending money, then you definitely don't have any chain of title ownership. So you're not going to get these tax benefits. Alan Foster asked, I just did a full rehab on a property. I can keep track of everything I put in the property, and then I can take that as a lump sum this year.
So you can, whatever money you're spending on capital improvements should be depreciated. How much of that will be considered accelerated depreciation, that will depend on what the money was spent on. Certain things, if it's structural, and again, structural and non-structural, these are the categories, but the IRS has different definitions than you and I may have of definitions of what those are. And so one thing is, for example, flooring. If you put in tile flooring, that's considered structural. If you put in vinyl or or LVP or carpeting, that's considered personal property and five-year property. So it may be a difference, a kind of nuance of what you're doing, but a lot of the spend, typically speaking, on capital improvements can be depreciated in that accelerated fashion and be eligible for bonus depreciation.
Perfect. And Dwayne made a comment here that he allocates 100% of the depreciation to his LPs, which good for the LPs, but that's something I always bring up. I mean, that's the beauty of being an LP, right? Is that you get all those all these amazing tax benefits.
Right.
Just another random question that just popped in, and I'll probably ask this also to maybe Justin and some of the other CPAs in the room, but I keep hearing more and more from CPAs because there is a question about 1031s in here that it's actually with the cost segregation and especially the bonus depreciation, you may not even need to do a 1031. You're able to sort of get rid of that tax problem you have through the bonus depreciation structure. Is that something you can comment about, or is that more of a CPA question?
No, it's a good point. I'm happy to comment on that. I like to call it, and kind of touching on the point that I made earlier about the passive losses and the passive gains of the sale. 1031, are still excellent. And I think the question really comes up here in terms of, can you do a cost segregation if you've done a 1031 exchange? Because there were some changes in the Tax Cuts and Jobs Act with regards to personal property. And so there was a lot of confusion in that for a couple of years until the IRS came back and clarified what they meant in the original law. And so without getting too confusing here, you can still do a 1031 even though you've done a cost segregation study. I think that maybe was what the question was. There's really no limitations to that. However, going on your question, Mauricio, what I like to call the lazy 1031 exchange is exactly that. If you don't do a 1031, you're going to have this big capital gain bill. Well, if you buy another property in the same year, do a cost segregation, you may have a huge amount of passive losses that will be able to offset those passive gains from the capital gain from the sale of the other property. Now, I call it a lazy 1031 because, again, you don't need to go through the hoop, but at the same time, it's not as beneficial of necessarily deferring the capital gains, because you are using, if you do this, you are using deductions that can be used to offset higher income tax burden, and using that to offset capital gain law burden, which is a lesser tax rate. So it's like using a higher ticket to offset something less. So some CPAs will say, well, it's not worth to do that. But again, there are a lot of options out there, and it's just important to know what your options are.
That's the key, right? What are your options? Because that's the issue that pops up more times than you would think, which is somebody's doing a 1031. They're in the middle of a 1031, especially with syndications, and they're stressed, or they may end up blowing the 1031. They can't find the replacement property. The 1031 isn't going according to plan. They're stressing out, or they're desperate to put it somewhere. They just want to put it in any syndication that pops up because they're up against the deadlines. And just knowing your options, that it may make sense to call somebody like you, Yonah, to say, hey, if I don't do the 1031 because I just can't find a replacement property, I don't want to put my money into a crappy investment just because I need the tax benefits. There might be an option to get around your tax problem through the bonus depreciation versus doing the 1031. So know your options. And let's talk about sort of not the elephant in the room, but the bonus depreciation is a relatively new, I forget what year it passed, 2017, 2018, but that's got a shelf life, right? So talk a little bit about, when is that bonus depreciation going to end? Because it's not going to theoretically be a gravy train forever. And my second question on that is just your thoughts on whether it is going to end, because I hear a lot of people thinking it may get extended.
100%. Yeah. So you're absolutely right. It does go down. When it was put into law in 2017, it had a shelf life, like you said. That 2022 is the last year for the 100% bonus depreciation. It's going to start phasing out by 20% each year, which means for a property purchased in 2023, you can take 80% bonus depreciation, and then it will keep going down by 20% until it's completely phased out. It will still be extremely beneficial, and I think people forget the fact that for many years, there was no 100% bonus depreciation, and cost segregation was still being done by everyone. It was still, obviously it got a lot more, I think in the past 5 years or 4 years or so, it's gotten a lot more attention because it's just, well, maybe it has something to do with the fact that, I've spoken about this on a few hundred podcasts and stuff. Maybe not, I don't know. But I think that people are excited when they hear about bonus depreciation and just, offsetting as much tax as possible and think, well, now it's going to be less beneficial. It's still going to be huge. Okay. You're still going to be able to probably offset all, if not all of your income from the property, almost all of it. And typically speaking, when you're doing especially on a syndication, you are typically have like a huge loss, right? If you're doing 100% bonus depreciation. So you'll still have a huge passive loss. If you do 80% or even 60 or 40%, you're still going to be left with that. So just to kind of clarify that, but yeah, it will be phasing out. So it's important to know.
And is it literally like 80, 60, 40,
20, 0,
5-year period?
Yeah. And, whether or not that will be extended, I've heard, and I think someone commented on my post, I did a big post about this yesterday about bonus depreciation, and a CPA commented there, I forget who it was, maybe they're on the call now, I don't remember, but that, they tell all of their clients to write letters to their local representatives that they should, try to lobby to keep this going, for the future. So I think it's important, obviously this 100% bonus played a huge role in the real estate game for a lot of people. And I think in turn had a great effect on the economy, at least for the past several years.
Yeah, sure. And from just sort of on my business side, always just wondering whether there's going to be a mad rush here at the end of the year to get all these properties purchased just to make sure that, the bonus depreciation is captured. But like you said, next year, you're still going to have the bonus depreciation. It's just 80% as opposed to 100. And then the year after that, it'll be 60%. So Vinny, that was kind of the answer to your question about what happens on January when it doesn't all go away. David's asked, if you live in California, this maybe it's another California, this is what I get all the time, Yonah, like, what if I do this or what if I do that? But David,
I know it's like the attorneys get all the tax questions and the accountants get all the legal questions. So they're like, right?
David asked, if you live in California, but your properties are in a holding LLC where a bonus depreciation is recognized. So I'm thinking, I own a California property in a Wyoming LLC or something. Can I, as a California resident, still take advantage of the bonus depreciation in all of year one?
So as far as I'm aware, and again, I'm not a CPA and don't really deal with California taxes. I did live in California at one time and do know that the franchise tax board is brutal and will come after you regardless. If your property is in California, regardless if your LLC is in a different state, you're still going to be, paying state tax on everything just because you live there. Yeah, so
there's no chance you're getting around that. I mean, that happens on asset protection as well. I mean, the state, it's probably the most aggressive franchise tax board in the country. And they take the position that basically, if you look in the direction of California, you're doing business in California. So setting up an LLC in Wyoming, it used to be that, they would get you because you were the manager of that LLC. And so, you were doing business from California. Then we got smart and kind of just made a Wyoming entity be the manager. But now it's basically, if anybody in the ownership chain is a California resident, then for purposes of all, because otherwise imagine that everybody in California. I mean, if it was that easy, everybody would just set up foreign LLCs and wouldn't have to deal with it. So,
right.
Let's see more. I got a bunch of questions. I want to make sure I take them in order and cognizant of your time.
Keep them coming. Guys.
There was a question, actually, I'm going to ask this. The question wasn't quite sure whether it was relevant, but it actually had to do with opportunity zones and whether it applied or how it would apply to opportunity zones. And of course, here it is. This is from Christopher. Thanks, Christopher. Good to see you, my friend. This may be outside of the realm of the cost segregation discussion, but can you touch on how cost segregation, depreciation, recapture is handled through a qualified opportunity zone investment property, assuming held for the max term, December 30th. So anyway, obviously, let's not get into the weeds of opportunity. There's obviously, depending on how many years, when you did it, you might get a 5-year, 7-year, in terms of, but how does it work then with the recapture? So let's say I'm in an opportunity zone and I buy a property and then 10 years later I sell it, because at that point, I get to sell it tax free.
Right.
How does do you know how the recapture works in that scenario with since I'm not paying any taxes anyway on the capital gains?
Right. So depreciation is going to be treated differently than the capital gains. So it does not have the same stance as the rules as the capital gains being able to be deferred. I think that's the whole point of investing into opportunity zone to defer or at least or wipe out this capital gain taxes. Even though recapture tax is similar to capital gain, it's a gain. but it's not the same in with regard to being canceled out. So unfortunately, as far as I'm aware, and I'll leave that caveat there that, ask around. Don't take this as gospel or anything, but no, I don't think you will be able to cancel out the recapture tax on that.
Yeah, well, you'd think that I, as the attorney, would have all the legal disclaimers at the beginning, but yes, there's no this is not legal advice, just education and ideas and things to touch. But actually, you know what? I'll give you. I was going to give you obviously a plug. I got somebody called G Money. I don't know. Are you in the house? But G Money was actually asking today, do you have a cost segregation analysis company that you can refer us to? And I said, well, this is what our friend Yonah's company does. And so if you need any help, he's not just an expert talking about it on his 200 podcast and his own podcast, but this is what he does. This is what he's an expert in. So if you need a company, just reach out to Yonah. We'll put the info here in the chat before we're done here. I'm not gonna. That's a political, Dwayne. I'm not gonna get into politics over here. We're agnostic here on that one. Alan asks, I've been reading about Delaware trusts for syndication 1031 eligibility, but I don't know that it's so special. What's so special about them? I will say that, don't hold me to it, but I think our next week's live will be on DSTs, because I just get a lot of questions about Delaware Statutory Trusts. But Yonah, any comments on how cost segregation and the Delaware trusts interact, or does that ever come up in your practice?
It does, certainly. We're actually Madison. We have a sister company, Madison 1031. So we do deal a lot with the tax laws, surrounding 1031 exchanges, et cetera. Important to note, there are two different things called DSTs. Okay, so there's Delaware Statutory Trusts, which are similar to REITs in a lot of ways, but they have special rules where you're able to defer your capital gains by investing in them instead of doing a 1031 exchange. But essentially, they're REITs. I mean, you're buying into a trust that owns a bunch of properties, like a REIT. There's something else called deferred sales trust, and that also gets a lot of attention, and that's also potentially an option instead of doing a 1031 to defer the capital gains. I'm personally a little more skeptical around that. I know there are experts out there, but it is not, federally, recognized, definitely not recognized in all states. So it's not as clear cut as the Delaware statute does, but it is again, the eligibility or the syndication. The problem with syndication, I think someone else asked above, Randy asked above about LPs investing 1031 exchanges. And it's really similar kind of question here. Is typically speaking, the ability to invest to do a 1031 exchange is that the owner is exchanging one property for another property. But when you have a bunch of owners in a syndication, the only way to really do that properly is that everyone all together that's in this syndication will all go together and invest in that new property through a 1031. So since there are sometimes hundreds or dozens at least of investors, it may not be feasible or everyone wants to do that. So that's why they won't do that. However, some syndications do offer that by creating a tenants in common structure that will allow you to kind of invest in your own portion of that property, which will then do a 1031 exchange. So there are options with regard to that, but it's a little less popular because of I guess more than anything, because of the legal fees involved.
Yeah, I mean, that was a great question from Randy, and I was going to do it at the end, but yeah. So when it comes to the 1031, Randy, you can absolutely do it. And we have lots of clients that do it coming in, right? But we have one investor, let's say you're selling your property, you want to go into a syndication. Obviously you cannot go into the LLC itself because it's got to be it's just an asset swap. You're just exchanging your current property for a future property. But so you just have to go in as a tenants in common. So if you're selling your property and that cash, it represents, let's say 10% of the syndication, you would just come in as a 10% direct owner of the property. So you have direct title ownership of the property alongside with the syndication LLC. What Yonah was referencing, which is on the back end, that's really difficult, as you mentioned, because if you've got 40 LPs in a syndication, usually I would say you wouldn't be able to do it unless it's been disclosed in the PPM, right? So when people wrote a check at the beginning, they weren't expecting they were expecting this to be a 5 to 7 year deal. And you suddenly come back to them and say, hey, we found a great 1031. We're going to do a 1031. And so you're going to be in it for 10 or 12. That's
Right.
not going to fly. But yeah, it's a difficult thing. Keep them coming here. The drop and swap. Yeah, Justin. Yes, you can do the drop and swap. Victoria asks, how do we as syndicators sell the idea of cost segregation benefits to a newbie investor who does not have passive income yet, but are high W-2 earners? Do you have a program at all? I mean, if I'm an LP and I want to invest, and the syndicator's kind of trying to sell me on this tax benefit, how do you educate them?
I think the best form of education, or the best thing to mention to them, is that yes, you're not going to be able to use these tax deductions to offset your high W-2 income, but at least here is an investment vehicle that during the life of ownership, you're not going to be taxed at all on the income coming from this, and potentially even down the road on the sale. And so therefore, there's basically no other investment vehicle, or very few out there, that you can have this investment, get great returns, build equity, et cetera, and not be taxed on that as well. And so that's really how I would sell it if I was selling it to passive investors, is that, here is a great way to reduce or create a tax shelter for at least a certain amount of money of income that's coming in. It's going to be small, okay? We're not talking about large amounts of income necessarily, but that builds over time, and it continues to build, hopefully as tax-free as possible.
Yeah, I think you mentioned, I mean, if they're high earners and they don't have any other passive income yet, but it all carries forward, so eventually they'll be able to take that, right?
Correct. And the passive income from the investment itself, meaning they may not have any yet, but by doing this, they will be creating passive income through the investment, and that income will be sheltered.
Yeah. And Dan asks, does the type of asset purchase matter, whether it's A property, B property, C type? Does that have any impact on the bonus depreciation?
It does have a slight impact when you're talking about multifamily. A-class typically a really new build. When you're talking about, and this gets into kind of the nitty-gritty of cost segregation, but the new builds, usually there's going to be more value in the structure. It's just simple. You just built it. The structure has a lot more value in it. We're looking at the way the cost segregation works is we're looking at a property, the purchase price, and we're basically reverse engineering the property based on the purchase price, and finding what all the individual components are and how they all add back up to on a percentage basis back into that. So in a new build, a new construct, Class A, more value is going to be in the structure, which means less value will be in those personal property, those items that can be depreciated faster. So it's a small amount. I wouldn't say it's a huge difference, but it certainly can be significant if you're talking about like a large property.
You can also, you can depreciate, I don't say anything, but not necessarily on the cost segregation part. I mean, people depreciate planes all the time. You hear that with people buying private planes. It's like that you get to depreciate the whole plane in year one. Do you know if they do something, do they have to do something similar with planes or any non-real estate? Or is that just, hey, I bought a plane for $10 million. I get to write off $10 million.
Yeah, you write the whole thing off. That's just straight up tax deduction. The whole difficulty of cost segregation is breaking down a property that has so many of these individual components to it. When you have one thing, that's how much it costs. You just write that off. But when you have this huge thing that has thousands of parts in it, and you don't know what the parts values are, you can't write them off on their unless you can break it down.
Yeah, good point there. We've got a couple more minutes here. So if you got any more questions, drop them in the chat. I'm going to ask about, I've heard this, any risk of audit, like does the risk of audit increase if you start using the stuff, cost segregation? The IRS frown upon it, is it on their, red list? Talk a little bit about the risk of audit, if that's a concern that somebody may have.
Yeah, definitely not on the red list. Definitely does not raise any red flags of audits. The IRS puts out kind of their dirty dozen list every year of certain types of things that are kind of loopholes and things that people are abusing. Cost segregation has certainly never been one of those things, since the rules are directly from the IRS and it's pretty straightforward. Just to kind of give you an illustration, and it is anecdotal, but we've done, as you mentioned, over 20,000 cost segregation studies in the past 16 years. As far as I'm aware, we've participated in approximately 24 audits from our clients, over that 16-year period, which means that's a minuscule amount. And almost all of those were for, very large companies, corporations, holding companies that they're being audited anyways for other reasons. And, the conservation kind of goes in the mix. So again, it's not that the conservation is going to raise a red flag. It's, if you have other shady things maybe going on, or you've been audited for other reasons, IRS is going to audit you again, regardless. So yeah, nothing to worry about there.
What's the number one question you get that we haven't asked?
What's the number one question I get? Oh, how much does this cost? That's what people, that's probably
on my list. I can remember if I asked it already. It was actually at the top of my list here. But so how much does this cost? I mean, that kind of goes into the whole, is it worth it? If I've got a $200,000, duplex, does it make any sense? So talk a little bit about the cost.
Yeah, I mean, it's funny because that's probably one of the number one questions I get, but it is not contingent to tax savings. So unlike other type of things or tax strategies or whatever that they're going to take, 10% or whatever, nothing to do with that. We have a simple kind of rate, a formula based on the size and scope of work or property. Typically, I'd say on average about $5,000, $5,000 to $6,000 is what any type of property is going to cost. There are smaller properties like single families that'll be less than that. Larger, skyscrapers, shopping malls, et cetera, that'll be a little more than that. But like multifamily properties, for example, will, self-storage, retail centers, things like that. It kind of average in that 5,000 to 6,000 range.
Awesome, my friend. And people are already starting to ask how does people get a hold of you?
Johannes.
Yeah, you do such an amazing. I'm gonna give a plug. I'm gonna give a plug here. There you go. You've got so many ways to communicate it. But if you're not following Yonah on LinkedIn, if you're not on LinkedIn, period, I think you're missing out. But if you're not following Yonah on LinkedIn, definitely do that. He's got so much amazing content there. But your website as well. But what's the best way that somebody can get a hold of you, just in general, to follow you, your podcast, but also if somebody's actually interested in hiring a cost segregation like G Money over here, who is looking for a recommendation, how do they get a hold of you?
Yeah, I would say connect with me on LinkedIn. Give me a note. Just don't just connect if you're not already connected. Don't hit the follow button. Actually hit the connect button and leave a little note. Say, was on the presentation, was on the webinar, whatever it is. I always love that. You can start a conversation there. Johannes put my website there, so appreciate you for doing that. I'll drop my link.
That'd be great.
Link tree over there that has a lot of other stuff I got going on.
Esther was saying he highly recommends you, and I've got so many of my clients that use you. So obviously, if you're in need of a cost segregation company, Yonah is not called the Cost Segregation King for nothing, and there's it's no accident that we were kind of joking around with the farming of goats, because that obviously the goat has a couple of different meanings. So your reputation precedes you, my friend. So really appreciate you taking the time. I apologize for the technical difficulties that we had with the audio. Hopefully the audio comes out great. And thanks again for your time, Yonah. Always appreciate you. If you are listening to the replay, I think it's going to come out before tomorrow, but if you are listening to the replay and you have questions for Yonah, you can obviously track him down somewhere, but you're also doing another one of these with our good friend Brandon Turner and Open Door Capital tomorrow, right? So if you've got a question you didn't answer, do you have the details on that, or can they find that on your LinkedIn page?
Yeah, on this Thursday, 8 p.m. Eastern with Brandon Hall, Open Door Capital. I posted about it on my LinkedIn page today, so you can definitely, and also on Instagram, I think I posted there, but you can definitely check it out there.
All right, my friend. Well, I really appreciate you, and thanks to the entire community for participating. All 60 of you that joined today live, really appreciate you guys, and we'll see you next week. I think I am going to do it on DST, so hopefully we'll see you there. Thanks, Yonah, again, my friend. Really appreciate your patience and coming on.
My pleasure. Thank you, guys. Awesome group. Thanks for everyone.